PPI and CPI are on the rise, which means inflation is on the rise. And that brought some unexpected volatility this week, with the S&P 500 closing negative for the second time in 16 weeks. So what does this mean for yields? Today, we discuss that and look at what fund managers are doing with their portfolios in light of all of this and how we should approach a higher inflation backdrop. So sit back and join us today as we discuss stocks and the financial markets together. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, and if you stay until the end, I got a couple of trade ideas for you guys. Let's get into it. Here's the heat map for the day. The market came a bit undone after that PPI print. We saw quite a lot of buying in consumer defensives, healthcare, quite a bit of rotation into these defensive sectors. We also saw energy outperform the broader market, so inflation hedges. And then we did see other defensive names being bought, stuff like Berkshire, and then earnings winners, stuff like Applied Materials. That really boosted semiconductor equipment manufacturers. And that's really why we saw, again, Nvidia, the magical stock, outperforming the broader market. But all in all, look at tech, look at comm services, look at discretionary. It was pretty red in these like growth names across the board. Okay guys, here's the daily chart of the S&P 500. So we were down 0.5% today on the back of the PPI print. Now, this right here was Monday's candle. We got the CPI print. We went all the way down to this 49.20 level, right? Then we get the PPI print, also hot, not quite as a severe reaction. So one thing to note from that is either the CPI print, we overreacted severely, or the PPI print was not quite as bad as the CPI print. That being said, still down 0.5% for the day. 0.9% for the Nasdaq 100. So still a pretty red day all in all. A couple of things to note. We are in the window of weakness. So right here, the 49.20 level. This is a very key zone. I think a lot of market participants are going to look at because buyers came in strong here, took us all the way up last week, and buyers came in again after the CPI print, took us all the way up, and then we did get a red candle on the PPI. I think the market was expecting some form of a hot PPI print, but we did close above the open of yesterday. So we did see a bit of buying towards the end of the day, but still overall a pretty red day. If we actually go ahead and look at the 5-minute chart, if you actually look at this chart right here, we can see that this is where we opened. We came all the way down. Then buyers found value right here, sort of at the 5,000 level, took us all the way up. They did again, however, find value at the 5,000 level, but we closed at the day's lows after forming this higher high double top, right? So a couple of things that I do want to note here is that this is going to be a very, very crucial level. This 5,000, probably this level right here, this 5,000 level. If we break the 5,000 level, I think we're probably going to sell all the way down to 49.20 and do price discovery at that level, because that is the key level where buyers came in and supported price right here and right here in the S&P 500. If we do go ahead and break the 49.20 level, that's going to spell problems down the line, and then bears could probably look at this 48.50 level, but you know, that's a while down the track, maybe even the next week and a half. What bears do have on their side is the window of weakness, and if they really want to make a run for these lower levels right here, right here, right here, they do need to act quickly in the next week and a half, especially before March calendar year starts. Now, looking at sectors today, the best performing sector XLB, but also GDX, XLV, XLP, XLE. And really what you can see with all of these names is inflation hedges and defensive names. What got sold was like software, ITB, XLC. And yeah, the market getting a bit defensive today. What we really want to see is this rotation continue over the next couple of days to really define it as a rotation. And I say couple of days, no, we actually want to see like a solid week, maybe 2 weeks of a defensive rotation, inflation hedge rotation, for us really to determine it to be anything significant. But just 1 day of trade, I'm not going to take it as anything as such. And until we break key levels in the S&P 500 and see, continued buying in these sectors as well as utilities and energy for a prolonged period of time, and I would say a week to 2 weeks, that's when I'm going to say, hey, okay, we need to start looking at ways of protecting our portfolio. There's something sinister happening under the hood. Until then, we will do what has worked up until now, and that is technology, that is semiconductors, that is discretionary, that is buying risk on assets. But that can change at any time, and when it does, I will let you guys know. Now guys, OPEX just wrapped up and it was a nothing burger as per usual, but now we have to look ahead. What can we expect? And the week after OPEX, what we often call the window of weakness, tends to be pretty weak, no pun intended. We could see your average return since 1994, negative 0.72%, median negative 0.1%, 14 wins, 16 losses, and the next week and a half tends to be very negative in February. And we do know this from the seasonal charts I've shown you guys, and I've shown you guys ad nauseum. There are definitely some positive weeks in there, as you can see, but they tend to be less than 1% in most instances, whereas the negative weeks tend to be, as you can see, pretty negative, negative 2.67, negative 2.45. So it's best in this period to expect some volatility. But that being said, with the market rallying 5,000 and above in the S&P 500 and everything we've seen, if we do end up positive next week, don't be surprised. Now we got the latest AA sentiment survey, and I just wanted to bring this up just quickly to your attention. I know I showed it to you guys yesterday, but 42.2% of sentiment votes were bullish, 26.8% were bearish. And I just wanted to relate this to something right here, the consumer confidence and the stock market. Now, this is very interesting stuff right here. This is just the University of Michigan's Consumer Confidence or Consumer Sentiment Index. And JP Morgan have pretty much gone and marked out the troughs, marked out the peaks, and then calculated the subsequent returns that you can receive had you bought at each peak and trough. And you can see a 9 sentiment trough, 9 sentiment peaks, 24.1% return 1 year later if you bought every single trough. So when sentiment is in the dumps, that's the time you actually want to buy. Sure, you may sit through a drawdown, but you have to look at the bigger picture. And here's the crazy thing. If you buy the peaks, you only get a 3.5% return, probably around the inflation rate. So a real return of 0%. So all in all, guys, the best time to buy is not necessarily when we're at these highs. While I don't say don't buy at highs, in fact, I always recommend buying stocks over using your money for virtually anything else. But it's best to buy when sentiment is, really at the lows. Nobody wants stocks. That's the time to be contrarian. And this was the sentiment at the start of 2023. Bloomberg released a monthly survey of economists. About 70% said that there was a chance of a recession in 2023. This was released on the 7th of January. Look at what 2023 did. Everybody was bearish. Absolute fantastic rally. 48% return in the Nasdaq 100, 26% in the S&P 500. Moving on, looking at the NAM exposure index, all this index tells us is how exposed fund managers are to US equities, and they're sitting at 95.58%, and they're holding quite a lot of US equities. Now, what exactly are they buying? According to BofA's Global Fund Manager Survey, the top 3 things is equities as a whole. So, they're buying stocks, but what stocks specifically? They're buying comm services, technology, discretionary, and they're mostly looking at US names right here and Japanese names. So they're buying US and Japan, and they're buying comm services, tech, discretionary names. So in Japan, those stocks would be stuff like Sony, Toyota, SoftBank, and in the US, you're literally looking at the Magnificent 7 names, right? So that is what fund managers are buying. Now, the reason why they're buying is because of earnings. Now, we got this latest earnings data info from BofA. We are tracking fourth quarter 23 earnings growth of 11.7% ex energy and finance. Now, I'm going to be real with you guys. These guys are like 2 weeks late. Last week, they were saying 5%. I was sounding the alarm on this 2 weeks ago. On the 2nd of February 2024, I told you guys, if energy is excluded, the growth in earnings is 9.7%. Now, guys, please go follow me on Twitter because I've been sounding the alarm and providing you the absolute hot sauce on Twitter. So go follow me on there, guys, or X, whatever they're calling it right now. I was sounding the alarm on the 2nd of February saying, hey guys, 9.7%, we are going to rally because earnings are coming in much better than expected, right? 80.1% of earnings have reported above analysts' expectation, beating the long-term average. And this is exactly what we've seen. Look at the rally we've had since February 2nd. And because of that, fund managers are allocating to equities at the highest pace ever and reducing their cash. Cash levels reduced to 4.2%, the lowest since 2021. And before that, we're looking at 2013, 2011. And why get 4%, 5% in a treasury over 1 year when you can literally go out and get 5% every single month trading semiconductors, technology, and consumer discretionary? That's just how bullish things are right now. And that's been happening for most of November, December, January. We're tracking that for February. The last 4 months, 20% plus, 25, 30% returns. So, why hold cash when you can get so much return in equities? And things are looking ever so more bullish, especially with earnings the way they are and earnings being constantly being revised up. And we can see at the same time, money market fund yields have declined since rate cuts are getting priced in. At the end of the day, a lot of the talk of the town is that rate cuts are moving further out, moving further out. You know what's also moving further out? The time we're spending in the year. We are in the second week of February, approaching the third week. Next month is March, and we would have nearly done an entire quarter in the year. So as much as rate cuts are getting pushed out, time is also flying, which is scary. I'm getting old, guys. But yeah, so this is one of the reasons why fund managers are holding less cash, holding more stock, holding more equities. Now let's talk PPI. This had the market on the ropes. PPI rose by 0.3%. Very hot. I think we were expecting 0.1. Now something to note as well, that the December figure, so this was the January figure, the December figure right here actually got revised downward. So it was at negative 0.1. It's now at negative 0.2. And I think that's why the market reaction to PPI wasn't quite as strong as the CPI print. That being said, PPI still came in hot, and over the next few weeks we'll see the market trying to decide what these CPI and PPI figures mean. Is it a once-off thing? Is it the start of accelerating inflation? I think that's what the market is going to try and price in over the next few weeks. What did that do for rates though? Not much at all. We're still expecting rate cuts in June, 145 basis points worth of rate cuts all the way up until December, but this is all subject to change. Think about it, just 3 to 4 weeks ago, we were expecting a 70% chance of a rate cut to the 500, 525 level in March. So this can change at any moment. And with the way PPI is looking, don't even let that surprise you in the next couple of weeks. Now let's switch gears, guys, and talk about Gamma. Now I'm not going to say a lot about Gamma because all of this is going to change on Tuesday when the new chart comes out, and a lot of this Gamma is going to be removed. So you want to watch at the size and amount of Gamma on the tape on Tuesday, as well as where this core Gamma resistance is going to be positioned. If it's at 50-50 or higher, bullish. If it goes to the 5,000 level, I think that's kind of bearish. I think that's very bearish, and I think we actually probably do see further sell side in the tape. With that being said, wait for Tuesday, have a look at this, and then make a decision on what you want to do, how you want to position yourself for the week ahead. What we also can see is that we are starting to roll over. Now, seasonally, we do see downward pressure in February, and we are turning at the exact correct point when we normally would. So what we do want to look out for is, when does seasonal weakness become a medium to longer term trend? That's what we want to look out for. So we want to look at key zones in the S&P 500. I think the first one is the 49.20 area. That's the very first key zone we want to look at. If we see buy side support there, that's probably just seasonal weakness. Anything lower, and it is looking a bit dicey for bulls. And we do know that right here, this area right here, this is the window of weakness. The next week and a half, bears really need to get going, because the window of weakness, Vanna and Cham, they're on holiday. They're not quite there. Those dealer supporter flows are not in the market. They do come back in the first week, and they come back strongly in March, especially because we are looking at a quarterly OPEX in March. So bears have the next week and a half to probably take us below the 4,900 area. If we do get below there, that's when things really do get a bit dicey for the bulls. But until then, I think we should just look at as every opportunity that the bulls give us, that the bears give us in this window, as buy side opportunities and dip buying opportunities. Now, looking at charts, this is the RSP. A lot of these charts, just yesterday they were looking pretty good, and now they're looking a bit dicey. I think what really needs to happen with all of these indices is they need to hold this area right here, these lows. The lows that they made on Monday, they need to hold those lows into next week and possibly try and go ahead and make a high above Thursday's high. We can see the same is true for mid-caps right here. Mid-caps looking relatively stronger than the RSP, at least over the last 2 weeks, I would say, but very similar situation. Hold this low, break this high. That's what mid-caps need to do. Same with small caps. Small caps looking significantly weaker, just because it barely went above this high, and it actually didn't go ahead and break this high right there, whereas mid caps did, relatively speaking, relative to the chart. But yeah, hold this low, break this high. That's what mid caps, small caps need to do. Bitcoin, this is actually looking very, very strong. Let's be real. We did see quite a bit of buyers, but I think just a bit of risk off into the weekend, and this looks very strong, and I do think Bitcoin is probably going to go higher. I wouldn't get in front of this chart until like key levels are probably broken in Bitcoin. Looking at gold, the last 2 days have been pretty bullish, but what gold is really doing, in my honest opinion, is forming this like wedge right here, and then whichever way it's going to go, that's the way gold is probably going to move. But for now, I wouldn't put any positions in gold. I would, if you are in a position, probably just hold. We did go make an all-time high right here, and realistically, that is bullish. But there's not really a lot of demand for gold outside of central banks. Looking at Supermicro, this is possibly a trade opportunity for next week. Nvidia did actually finish flat on the day. Supermicro was down 20%. I know it did run a lot harder, but maybe we see like one last capitulation on Tuesday, and then we probably look at a dip buying opportunity sort of around the 700 area for Supermicro to probably go and break the highs at 1,050, 1,100 in Supermicro. But if you've made it up until here, guys, thank you so much for watching. If you like this video, guys, please subscribe, hit that notification bell, like this video, guys, leave a comment. Cheers.